This video is about tracing cash, the operating cycle, and the cash cycle. I'm your professor, Dr. Stephen Haggard. So let's talk about tracing cash and net working capital. So our goal here is to describe what happens at the firm regarding the short-term operating activities and what that does to our cash, whether it be cash coming in or cash going out. Well, let's start by talking about what net working capital is. Remember that a current asset is anything expected to produce cash within 1 year, and a current liability is anything expected to consume cash within 1 year. Net working capital is defined as current assets minus current liabilities. And because we would always rather have more current assets than current liabilities, then we want our net working capital to always be positive. This is a good sign that we might be able to pay all of our bills over the coming year. Let's take a look at cash and our balance sheet. So where do you find cash on the balance sheet? Well, it's a current asset. So you're going to look in the upper left-hand corner. In fact, cash is the first thing listed because it is the most liquid of all assets, and things on the balance sheet are ordered in descending liquidity. And we can start with our net working capital definition here, which is current assets minus current liabilities. But I want to do one thing. I want to break those current assets into cash and other current assets. And you're going to see why we do that here in just a second. What we can do now is look at our balance sheet, our modified balance sheet. If you take the net working capital plus the fixed assets, basically that's like current assets minus current liabilities plus fixed assets, so that's total assets minus current liabilities, that is equal to the long-term debt plus equity. If I were to add current liabilities to both sides of this, then we would have just our regular balance sheet equation. Now I'm going to substitute for net working capital what the things that I have above. In other words, cash plus other current assets minus current liabilities. That's where I'm substituting for net working capital. Plus my fixed assets is equal to long-term debt plus equity. And then I'm going to solve all that for cash. Now, why am I doing this? I'm doing this because then we can see what happens to cash as each of these other things go up and down. For example, we've got cash is equal to long-term debt plus equity plus current liability minus other current assets minus the fixed assets. In this equation, anything that has a plus sign in front of it, if that thing goes up, then cash goes up. And anything that has a minus in front of it, if that thing goes down, then cash goes down. Now I want to point out what other current assets are, since we haven't explained that here. The other current assets that we typically talk about are the firm's accounts receivable, which are bills owed to us by our customers that we've told them to pay in 30, 60, or 90 days. These come as a result of us extending credit to our customers. And also we will have inventory as part of our current assets. Inventory, it's inactive assets sitting on the shelf awaiting sale or shipment, something like that. Basically, these things are expected to turn into cash within 1 year also. Now keep in mind that inventory is less liquid than accounts receivable, because when we sell the inventory, we will probably receive an accounts receivable instead of cash. And so in descending order of liquidity, it's cash, then accounts receivable, then inventory. So we can use this equation now to look at our sources and uses of cash. A source is anything that increases or provides cash, and a use is anything that decreases or uses cash. So what are our sources here? Well, anything with a positive sign, if that thing goes up, we are going to see our cash go up. So that means that an increase in long-term debt is a source of cash, but a decrease in long-term debt is a use of cash. Let's make sure we understand why that is. If you borrow money from a friend, your debt goes up, but the cash in your pocket also goes up. But what if you are to pay off some of that debt? Then your debt goes down, but your cash also goes down. Now, what about equity? If I issue additional stock, that's going to bring in cash, so that's a source of cash. But what if I were to repurchase stock? That would be a use of cash. And so when equity goes up, we see cash go up. When equity goes down, we see cash go down. Another way equity can go down is through the payment of a dividend. When a dividend gets paid, that comes out of the potential addition to retained earnings, but it also reduces the amount of cash the firm has. So what about current liabilities? Well, current liabilities are just short-term debts. And so as they increase, then we can say cash increases. So like an increase in accounts payable, which is our main current liability, would represent an increase in cash, and more clearly to most students, a decrease in accounts payable is a use of cash. Because after all, when I pay my bills, now I have less cash. Then we have decreases in other current assets. So, for instance, if I sell inventory for cash, that would be a source of cash. So if I have a decrease in other current assets because of that negative sign, that's going to increase my cash. It's a source. But if I were to use money to put inventory on the shelf, then my cash would go down. And so increasing of these other current assets is actually a use of cash. And finally, decreasing our fixed assets is a source of cash. What if we were to sell some spare machinery or sell an old abandoned warehouse? That would bring in cash at the same time we were decreasing our fixed assets. And what if we were, though, to buy a new machine? Fixed assets would go up, but our cash would go down. And as a result, we would see that increasing our fixed assets is a use of cash. Now let's turn our attention to the operating cycle and the cash cycle. So the operating cycle is the number of days between the acquisition of inventory and the collection of the cash that we receive for selling that inventory. We also can talk about the cash cycle, which is the number of days between paying for the inventory and collecting cash for the sale of inventory. Now, if you're purchasing your inventory on cash terms, these will be identically the same. But most of the time in American business, what we are doing is purchasing goods on credit. And so we don't have to pay for them immediately upon receiving them. And so typically what we'll see is the cash cycle being shorter than the operating cycle. So here's a nice little picture. On the top half of this, we have the inventory being purchased, and then we have the inventory. You may also have that be, think of that as the number of days sales in inventory. And then at the end of the inventory period, that inventory is sold. But we don't receive the cash yet because after all, we sold that stuff on credit. And so now we have to wait for the accounts receivable period to be over. Now, accounts receivable period goes by a couple of names. We could talk about days sales in receivables or the average collection period. These are all the same thing. And if I add together the inventory period and the accounts receivable period, that gives me my operating cycle. Down on the bottom, we can look at the cash cycle. That first part there, the accounts payable period, represents the period that I have the inventory, but I haven't had to pay cash for it yet. And so that's not actually going to be part of the cash cycle. The cash cycle actually starts when we pay cash for the inventory. And it continues until we receive cash for the inventory. So here's our operating and cash cycle example. We can calculate the operating and cash cycle times using the info that we are given below. Now this is the kind of detailed transaction data that only companies will have for their own operations. I'll show you here in a little bit how to do this for someone outside of your own company. So at day 0, we acquire the inventory. If we're buying that inventory on credit, there's no cash effect at all. And once again, typically in American business, that's the case. And then on day 30, we pay for the inventory. That tells me that our supplier gave us 30-day terms, meaning they expect us to pay in full in 30 days. Well, that's definitely going to have a cash effect, and in this case, it's $1,000 that we are paying for this inventory. On day 60, we're going to sell that inventory on credit. Now notice that this has no cash effect. Why? Because we have to wait for the average collection period or average days sales and receivable, or basically the receivables period, to pass before we collect that cash. When do we collect? On day 105. Apparently we are telling our customers to pay us in 45 days, and on that day we collect $1,400. So what is our operating cycle time? It's the inventory period plus the accounts receivable period. And so it's going to be the full 105 days that we have there. But what about the cash cycle time? It doesn't include the accounts payable period. And so it won't include that first 30 days. And so we're actually only looking at 75 days for the cash cycle time. So we can also calculate these using information that we can get from the balance sheet and the income statement. Now this comes in really handy when you are analyzing a company and you don't have the internal data. This could be a competitor, or it could be a company that you're thinking about buying. And so you could actually go out there and look at their publicly available financial statements and get the information that we're about to use to figure out this operating and cash cycle information. So what information do we need? Well, from the balance sheet, we need the beginning and ending inventory, accounts receivable, and accounts payable. And from the income statement, we need net sales and cost of goods sold. Now, note that this is probably a retail store income statement. And the reason I say that is because the top line here is net sales. For people who do not receive a lot of returns, maybe you just see total sales at the top, or it might even say total operating revenue. So don't let that freak you out. The income statement, the top line, often says something different. And so our operating cycle is simply going to be our inventory period plus our AR period, AR standing for accounts receivable. And our cash cycle will simply be the operating cycle, which we just calculated, minus the AP period. What does AP stand for? Accounts payable. So let's calculate that inventory period. So we can use two items to determine what is the inventory period. First of all, when you studied financial ratios, you learned that inventory turns are costs of goods sold, or COGS, divided by inventory. Now in this case, we're going to use the average inventory. If you're only given one inventory number, just use that one. But in this case, since we're given beginning and end, we add them together and divide by 2. Now let's talk about the reason that we use cost of goods sold here instead of sales. And the trick is that cost of goods sold and inventory are both recorded at cost. So if I pay $8 for an item and then sell it for 10, it'll show up in both cost of goods sold and inventory at $8. And so we do that so we'll have a fair comparison, an apples to apples comparison between the cost of goods sold and the inventory. So in this case, our cost of goods sold is $8,200. That comes from the income statement. And our average inventory level is $2,500. That tells us that our inventory is turning 3.28 times per year. How do I know per year? Because that cost of goods sold is reported on a per year basis. So that allows us to calculate our days sales and inventory. All we do is take 365 days per year and divide by the inventory turns, which are per year, and the per years cancel out, and I am left with 365 divided by 3.28, which is 111.3 days. So that's our inventory period, 111.3 days. Now what is our accounts receivable period? So we're going to use 2 items from our previous study of financial ratios to calculate this. First of all, we are going to calculate receivables turns. And when we calculate receivables turns, we want to look at credit sales only. Now, unless I tell you otherwise, or unless you are told otherwise, all sales are on credit. In truth, this is pretty much the way it works in the US and around the world. There are a lot of businesses that run purely on credit. And so we are going to assume all sales are credit sales unless told otherwise. And then we are going to divide by the average accounts receivable, unless I'm only given one number for accounts receivable, in which case I will use it. Now let's talk about why we are using sales here instead of cost of goods sold. Well, it turns out that similar to our cost of goods sold and inventory example, sales and accounts receivable are recorded in the same way. Remember the $8 purchase and $10 sale example from the last slide. In that slide, both cost of goods sold and inventory were $8. But on this slide, we are looking at sales and accounts receivable, both of which would be recorded at $10. So if we want to have an apples-to-apples comparison, we have to use sales and accounts receivable. And when we do that, we wind up with 6.39 as our receivables turns. Now, where does the sales come from? Comes from your income statement. And where did the accounts receivable come from? The balance sheet. So our days sales and receivables is simply 365 days per year divided by our receivables turns. And when we do that, we get 57.1 days. And so now we are able to calculate our operating cycle. All we're going to do is take that inventory period and add the AR period. And that gives us 168.4 days. So what's the interpretation there? It takes 168.4 days on average to collect cash from the credit sale of an item purchased for inventory from the date of purchase. Now notice we say on average. Not everything stays in the inventory exactly 111.3 days. And not everything takes exactly 57.1 days to receive the money that we're owed. What we're talking about here is on average. So let's talk about the accounts payable period. We are going to, similar to our last 2 slides, figure out what are our turns and then use those turns to figure out days. Now, we are going to use cost of goods sold divided by the average accounts payable, unless, of course, we're only given one accounts payable, in which case we just use that number. Now, why are we back to using cost of goods sold? Because, once again, these things are both recorded at cost. If we are buying something for $8 and selling it for $10, it's going to show up in both the cost of goods sold and the accounts payable for $8. And so this is a fair apples to apples comparison. What about our payables turns? Well, we're going to take that cost of goods sold, 8,200, and divide by 875, which is our average accounts payable. Now, there is an assumption here that all of our materials are being purchased on credit, and that's actually a pretty good assumption. And so what are our payables turns? 9.37. That's 9.37 times per year. So what are our days sales in receivables? I'm going to take 365 days per year, divide by my payables turns, which are also per year, and come up with 39 days. Well, now that I have the AP period, I can go ahead and calculate my cash cycle, because after all, cash cycle is just the operating cycle minus the accounts payable period. So I take the 168.4 cash cycle days and subtract the 39 days of the AP period to find that our cash cycle is 129.4 days. What does that mean? It means that from the time we pay cash for our inventory, it takes us on average 129.4 days to collect that cash. Let's talk about how we can go about shortening the cash cycle. You can do several things to shorten your cash cycle. You can reduce the inventory period, which is the same as increasing the inventory turns. Well, what are inventory turns? It's simply the cost of goods sold divided by inventory. So there are two ways that you can increase inventory turns. It's either through increasing our sales, and thus our cost of goods sold, or decreasing our inventory. Now, students always want to say that we should increase our sales, but that's never the answer in the short term. Let me explain to you why that is. Increasing sales, unless we do some sort of expensive promotion or advertising, involves working to develop new customers and develop relationships with those customers and to develop trust with those customers. So your ability to increase sales over the short term is basically zero unless you're doing something that costs a lot of money, which we don't want to do. And so what does that mean? It means we need to reduce our inventory. How do we go about reducing inventory? Well, the way to do that is to analyze your inventory and see which kinds of inventory you have too much of. So, typically there are two kinds of inventory. There's the inventory that we buy, so these would be purchases, and the inventory that we make. This would be production. We are very fortunate if the inventory items that we have too much of are the things that we've purchased, because all we have to do is stop purchasing those things and the inventory will come down on its own as we use that inventory. However, what if it's production? Then basically we have to reduce our production until our inventory gets in line. Now, when I ran my own operation, I tried to run around 48 hours per week. And then when I needed to reduce production, that left me just with a 40-hour week for my people, and I didn't have to lay anybody off. You don't always have that as an option, though, and so you may actually find yourself shutting down production in order to get your inventory of produced goods to go down. What about reducing the receivable period, which is also increasing the accounts receivable turns? Well, if you think about accounts receivables turns, it's sales divided by accounts receivable. Now, of course, students always want to increase sales, and that would increase accounts receivables turns, but once again, It's not easy to do that in the short term. And so what do we say you should do? Well, you've got to reduce those accounts receivables. How do you do that? Well, the first thing students want to do is offer a discount to get people to pay earlier. But the problem with that is it costs money. If I offer a 2% discount to pay early and my profit margin's only 2%, I've basically wiped out all my profit by offering the discount. So, how should I be lowering my accounts receivable? Well, the best method is simply to pick up the phone and call the people who are behind on paying you. Americans have an expression, the squeaky wheel gets the grease. You need to be the squeaky wheel. You need to be the complainer, because if there's only enough cash around to pay a few of the suppliers, then only the ones that call and ask will get paid. And if you have a customer that continually tries to abuse you in this way, what you can do is start calling them the day before the end of their credit terms and reminding them to pay. You'll be amazed how effective this is. And then finally, we can increase our payables period, which is also reducing our accounts payables turns. Now, the way that we would go about doing that is to increase our accounts payable. How do we do that? Well, I used to work for a company. In fact, I'll go ahead and name the company. The company was called Halliburton. It's still around. And when I told my cousin Ray, who had a trucking company, that I'd gone to work for Halliburton, he said, "Oh, that's great." He said, "They pay off like a slot machine." I said, "What do you mean?" And he said, "When I send them a bill and give them 30 days to pay, 2 days later, I have the check." Now, what does that mean? It means that Halliburton wasn't making good use of their accounts payable credit. That's basically a zero interest loan. And so Halliburton should have taken the full 30 days to pay my cousin, but instead they were paying him almost immediately. And so that's what I'd recommend you do. Take a look at when you're actually paying your bills. If you're paying your bills immediately, stop doing that and wait the full time to pay them. Certain unethical people will just wait for someone to give them a call before sending the money. I would not advise you to do that. When you enter into an arrangement with a supplier, you are agreeing to pay in accordance with the terms that they set forth. And so the longest you should wait would be the length of the terms that they provided to you. So let's talk about the potential negative impacts from doing these things. What about reducing your inventory? Reducing inventory could cause something called stockouts. Every time I go to Walmart and they don't have something on the shelf that I want, that's a stockout. And Walmart misses out on a sale, and if they miss out on the sale, they miss out on the associated profit. And what about calling our clients to get our accounts receivable paid in a timely manner? Well, that could get annoying to our clients, and it might eventually cause a customer to go somewhere else. And then what about lengthening your accounts payable? Well, if you were to actually go past the credit terms, your suppliers might eventually cut you off, and then you wouldn't have anything to sell to your customers. And so all of these things must be done thoughtfully, or they can lead to bad outcomes.